Welcome to the Market Huddle Plus. I'm Patrick Serezna with our weekly 30-minute catch-up interviews with past guests. This week, we welcome to the show Aidan Garrib, head of global macro at PGM Global Inc. Great to have you back on the show here, buddy.
Hi, Patrick. It's good to be back. I like the tan.
Oh, thank you, thank
Looking
you.
good.
So, let's have a chat about these markets. We have to start off by talking about the Fed. Like we're having you on here just a little bit more than a week away from the much anticipated point from which a rate cut cycle is potentially going to begin. We've spent virtually a year with rates unchanged, and we were looking for some sort of an economic reason for the cycle to turn and for them to start cutting. And here we are in a situation where now the debate has become, are they going to do 25 basis points or 50? And the most recent CME Fed funds futures are saying 27% chance of a 50 basis point cut. What's your take on all of this? Obviously, they're going to cut, but
Yeah.
what's your take on how the market is sizing this up, and what are they going to do?
Yeah. So I think in the over the next week, really what the market's focused on is the Fed going to cut 25 basis points or 50 basis points. But I think where a lot of the opportunity lies here is further out in the rate pricing curve, because I think anytime a narrative starts to shift either to rate hikes or to rate cuts or to you know escaping a recession or going into a recession, the pricing tends to move to extreme levels and then starts to correct from there. And so as it pertains to rates, I'm sitting here, I'm looking at Fed fund futures here, and there are 7 cuts, almost 8 cuts being priced in by March. There's 9 cuts being priced in by next September. So I just think some of those back end cuts are the ones that don't materialize. And when you look at pricing in different assets, you're kind of getting the sense that those asset classes are telling you that, hold on a minute, the rates market at least seems to have gotten too skewed perhaps in one direction, and it's time for things to come back a bit.
Okay. Now, how do you feel, or how do you size up the jobs markets? Because clearly there's revisions down, there was weakness. Like, do you think that this is just like a not anomaly, but this isn't going to become a feedback mechanism to a typical recession where unemployment goes spiking higher? Or do you think that this is just like a little blip, like a soft landing almost, and that the jobs market will be stable?
Yeah, and I think that's the key question. So fundamentally, I think the Fed does need to get a little bit more, kind of loosening of the labor market if they want to, get inflation down on a persistent basis. Now, the Fed's come out against that and said, look, we don't want to see any more, loosening here. So again, I think if they start to ease monetary policy into what is still a very strong labor market by historical standards, that creates like a feedback loop where some of the extreme rate cut pricing that you see in markets for 2025 starts to get priced out. So case in point, actually in the presentation deck I sent over, if you were to look at page 3, on the lower left-hand chart on page 3, what I show here is the Atlanta Fed wage growth tracker versus a ratio of job openings to unemployed workers. So the Atlanta Fed wage growth tracker, it's perhaps a better measure of wage growth than average hourly earnings, because it follows like the same cohort of individuals throughout the year, unlike average hourly earnings, which can be skewed by compositional shifts in the labor market. So what you see here is, look, wage growth is still, so this chart goes to 1999 or 2000. So you look at where we are, wage growth at 4.7% is basically, the fastest pace of wage growth that we've seen, like going back to the year 2000, right? And then if you look at the ratio of job openings to unemployed workers, sure, that JOLTS number, that job openings number is coming down. But when you look at job openings relative to the amount of people who are looking for work here, again, we're at 25-year tightness in terms of openings to unemployed workers. So it just looks like the labor market is still tight here. And if the Fed does start to cut into this historically tight labor market, then you probably get growth picking back up, you probably get inflation picking back up, and then some of that extreme rate cut pricing that you see further out in, whether it's OIS or Fed fund futures, some of that starts to get dialed back a bit.
So, if we were to like step back and look a bigger picture in terms of how many cuts do you believe will happen in this cycle,
Sure.
where do you think the trough is going to be in the rates, at least based on the macro conditions that you see evident today?
Yeah. So I think the key question there is, when do you start to see some of the, big ticket item spending, pick back up here? Because credit growth, particularly for those items, and on page 3 on the top right hand chart, you can see like nominal credit growth typically follows credit growth. So nominal GDP growth, I should say, typically follows credit growth. I'm on the top right of page 3. And you've seen this big disconnect here where nominal GDP growth, we actually had a revision upwards to 5.9% year over year. And credit growth is subdued at 1.5%. And I think what this speaks to is the amount of fiscal spending that you still have, in the system, both direct fiscal spending, but then also some of the subsidies for the Build Back Better Inflation Reduction Act, manufacturing, construction spending, that type of activity. And so, in this context, if the Fed cuts by 50 basis points, 75 basis points, maybe even 100 basis points in the next couple of months, I think you start to see a tailwind start to reemerge here for growth and for credit growth. And that's probably where you start to see some of the rate cuts further out start to get dialed back. So, I expect you could see, I would say, between 75 and 100 basis points in short order. So whether that's by the end of the year, by the first couple months of 2025, but after that, I think it should become apparent that economic activity is picking back up again, and it will be much more difficult for the remainder of those 7, 8, 9 cuts to come to fruition.
But typically, the Fed, when they start an easing cycle, need to demonstrate some degree of consistency. So, they I don't think that they easily pivot. I mean, we'd have to see, in my mind, some really positive economic news for them to just completely halt rate cuts. You think it's just a process that they might just slow the pace, where they're every second meeting maybe moving, and they kind of drag their heels a little bit to give them some optionality in terms of how they would play it out?
Yeah, I think that's how it starts. And then what happens is that you start to see improvements in credit growth. Perhaps you start to see improvements in, big ticket item spending. And then the market narrative begins to change, from 7, 8, 9 rate cuts to, hold on a minute, like the economy is starting to kind of reaccelerate here, and maybe that doesn't need to occur.
Right. Okay. So now you have this view that that we're at extreme of these macro conditions in some degree or another. How does a trader play this? So if you're like a pro trader at your institutional level, what are you recommending to your clients?
Yeah, so I think if for professional traders, they're likely doing, SOFR futures, spread trades between, like the Z5 and Z7, or U5 and U8, which are just, like the, so the, Z is going to be the December
Yeah.
contracts for 2025 versus 2027, or U would be the September contracts for 2025 versus 2028. And they're, you're seeing basically flat pricing between 2025 and 27 and 28. And so I think that's where a lot of pro rates traders would start to come in here and kind of short the longer end contracts, expecting those to re-rate
Okay.
as the
And so
rates
you're
start to
you're you're
rise.
basically just playing an adjustment of that curve on the SOFR futures.
Agreed. Yeah, I think that's how professional traders would be doing it.
And then, so for a retail investor that's, let's say, just looking at building a portfolio and just like looking at taking advantage of this kind of a view, what are some of the ways that you can, from a portfolio perspective, express this view?
Yeah, so that's a great question. I think there's two ways that you could likely do this. So one way is just having a view on US stocks, which I try to highlight on page 2, and particularly the growth versus value trade, which is these big factors, the growth factor and then the value factor. And over the last, let's call it decade, growth has really outperformed value. But I think there could be some catalysts here where if this is a mid-cycle slowdown as opposed to a recession, then I think value offers some opportunity here. So, for example, on the top left-hand chart on page 2 here, you can see consensus 12-month EPS growth. For the S&P 500, earnings growth is expected to grow by close to 14%. So this is hardly kind of a recessionary hard landing scenario that would warrant 7, 8, 9 rate cuts. When you look at the top right-hand chart here, I show percentage of firms upgrading or downgrading revisions for sales and for earnings. And so you see a lot of positive sales and earnings revisions, whether it's for tech, financials, utilities, consumer services, real estate, healthcare, and then for the S&P writ large. And then the pockets where you're seeing, sales and earnings revisions to the downside, I would argue that a lot of that isn't even necessarily like macro focused, but they're kind of there's specific reasons for that. Like large cap industrials are derating because some of the problems that some of the big firms have. If you look at small cap industrials, they're doing well. If you look at energy, that's kind of like an OPEC story, and in the context of like China's trucking moving to LNG, so you have less energy demand. But broadly, things look okay. When you look at the bottom left-hand chart on page 2, cloud CapEx, so this is like AI spending, it's doubled from 2023 to 2024. It's going to grow by another, like 13% here. So you're still seeing firms spend a lot of money, a lot of CapEx. So that should continue to support, growth and activity. And then really, I think the key chart to watch here for growth versus value, because this is where you can get a lot of juice from the US equity market, is the difference between free cash flow growth and earnings per share. For the S&P 500 growth stocks, so like large cap tech, there's not much disconnect between EPS and free cash flows. But for value stocks, you're seeing a really big disconnect there. And that's because of some of the inventory bills and the CapEx that you've seen the value firms undertake. So all of a sudden now, if you start to get rate cuts by the Fed, and some of these big ticket item spending, whether it's houses or autos, washing machines, these type of things, if consumption there starts to pick up a bit, then you'll see the gap between values, free cash flow yields start to narrow as that improves towards EPS. And I think that would be what what retail investors and a lot of professional portfolio managers are watching for the catch up of value versus growth. Right, and that catch up, that dichotomy, is where a lot of portfolio managers kind of earn their keep.
Now, do you think that when I hear a story like this, I mean, this is all dependent on obviously how these rate cuts are going, and it takes a certain while for all the effects of lower rates to start trickling in. Obviously, the market's already priced it in, so it's in many ways already in the markets. And is there in your mind a lag time that could occur here before this thesis starts to play out, or is this something that you think can like literally once we get through the kind of third quarter doldrums, that this could be the theme for the fourth quarter already?
Yeah. So I think once you do see the rate cuts, so some assets, securities, markets are priced off of implied rates, right? So what's priced into the curve right now. But other rates, like if you think about like mortgage rates, for example, they're tied to, I would argue they're more tied to the prevailing level of interest rates rather than like what's priced into the SOFR's curve, right? And so a key chart and a key opportunity, I think, for investors should be paying attention to is actually what's happening in the mortgage market, because that will serve, if you start to see mortgage lending pick up again, home purchases pick up, kind of these big ticket items start to pick up because rates are falling, then I think that will crystallize, that narrative that I'm talking about. So you can see a little bit of this on page 4 on the bottom right-hand chart. And then this also brings up a trade idea I really like here. So on the bottom right-hand chart on page 4, you can see I'm showing 30-year fixed mortgage rates in the US hovering at about 6.75%, 6.76%. And then you have the US Treasury yield, which when I ran this last week was 371. It's changed a little bit from there, but not much. And then the spread between the two, which is at essentially all-time highs, this spread. And so I think what's going to happen is if the Fed starts to cut and you get yields start to fall, then mortgage rates come down. That reinvigorates lending because not many people want to take out a mortgage at 676, right? So I think that can be one major catalyst for where the cyclical kind of trade starts to come back in. And I think mortgage-backed securities, so whether the bonds or the ETF that tracks them, I think investors should be looking at this for some opportunities. Because as you can see on the top left here, this ETF has really outperformed the Treasury index. So I guess this ETF and mortgage bonds, the way they work is, it's these bonds are essentially fully guaranteed by the federal government, by Freddie Mac and Fannie Mae, so the U.S. federal government agencies. So there's no real credit risk here and above what you get on Treasuries. And so generally what would happen is if rates fell very, very quickly, then you would have mortgage holders go and refinance their mortgages. And so depending on your outlook, that could be good or bad for these bonds, right? You would get paid. So if people are refinancing their mortgages faster, then you're going to get paid back very quickly, right? So that might be good, but it might be negative if you want a little bit more duration on your portfolio here. However, what I show is on the bottom left-hand chart on page 4, I can show the share of U.S. mortgages by interest rates. So, most mortgages in the U.S. are, in the 3 to 4% range, or maybe in the 5% range, right? So if rates just fall a little bit from here, then you don't get that prepayment really pick up. And so you're earning yields well above Treasury yields in a very safe asset class, because again, these bonds are guaranteed by the federal government. So I think this is an interesting place where you want to be invested, because if rates come down a little bit, then you're still going to be earning very high yields in these safe assets. And if rates fall even 100 basis points or 150 basis points, well, you'll get some cash flow acceleration paid back to you. But unless you think mortgage rates are going to fall back below, 4%, 3%, 2%, the prepayments aren't going to ramp up. So, you're still going to have some decent duration here. So this is something, retail investors, everyone can kind of put on.
So I love the ideas. They all make sense. The question I have for you is this. Let's go through a scenario where traditionally in the past, we have seen that during rate cut cycles, often the Fed is actually behind the curve. A recession starts and they can't cut rates fast enough because it becomes like a feedback mechanism. What would be the things that you would need to see that would change your story? Like where would you look for cracks that maybe things are actually going to get a little bit more on the hard landing side of things? And what would be your kind of trigger point for kind of changing your narrative?
Sure. So if you saw, I guess there's a couple of things. One, if you saw the U.S. consumer really weaken, so, retail sales, core retail sales really struggle, I think that would be one place. Obviously, if you saw massive increase in unemployment, job losses, that would be another. Now, the pushback is, look, that's at best a coincident, or at worst even a lagging indicator of the economic cycle. However, what we found is if you look at jobs in construction, those tend to lead their overall employment market. So if I started to see big layoffs in construction, either residential or non-residential, that would get me worried. Right. You don't really see that right now. The other thing I'm looking at is because a lot of the economic activity is created by the federal government programs, whether it's direct spending, because they're building roads and bridges, so transportation spending is very high. Or if you're looking at the subsidies from the Inflation Reduction Act that's driving, a manufacturing renaissance in the US and a construction renaissance. If you saw the leading indicators of those start to slow down. So, for example, architectural and engineering service jobs, if I start to see pretty big layoffs there, then that would serve as an alarm bell. Like, hold on,
Mm.
maybe these drivers of growth that have been so resilient over the last couple of years are really starting to slow. And we're getting this, hard landing type scenario that would warrant 7, 8, 9 rate cuts. But again, I just come back to the slide that I had on page 3 on the lower left-hand chart that still showed that, wage growth is still, if you strip out kind of the post-COVID, trend up and down that we've been on, 4.7% year over year wage growth on the Atlanta Fed wage growth tracker is, at the highest level essentially that we've seen over the last 25 years. And job openings to unemployed workers are again at, the highest rate we've seen over the last 25 years. So, I would get concerned if maybe some of these job openings were like phantom job openings, which I think, Mike Green has talked a little bit about. Um,
Yeah.
I'd be a little bit concerned, but you don't really see that here in the context of nominal GDP growth at 6%, 5.9%. Right. And actually, one other thing here is that growth, you see it reflected externally as well. So on the bottom right-hand chart on page 3, you can see emerging markets, even with all the
Mm.
problems that China's facing, emerging market growth is accelerating, right? Because the big fiscal deficit in the US is sucking in commodity imports from the rest of the world to do the build back better, the build, the concrete, the steel, the iron ore, all that kind of thing. So I see this strong growth in the US being reflected in external conditions too. And so that kind of gives me some comfort here. But clearly, if I start to see some deterioration in these more sensitive pockets of the labor market, engineering, architectural jobs, or construction jobs, then that would give me a really big reason for pause and say, okay, maybe we are in this hard landing camp, and the 7, 8, 9 rate cuts are warranted. But I don't see that yet.
All right. Well, listen, I want to touch quickly on yields before I talk carry trade because I want to get your thoughts on the carry trade as well, the yen one. But just going, a lot of people are looking at this twos tens steepening that was going on, and this it pretty much is toying with this idea of us finally getting from this inversion of negative on the twos tens. To finally seeing it positive. Do you think that this is going to be a trend where we get back in the positive territory and stay there? Is this the period of a negative inversion behind us?
I think it is for a couple of reasons. So one is if you were to look at how the steepening that we've seen here has taken place, it's been because there's been aggressive pricing of Fed cuts at the front of the end. So at the front
Yeah.
end, so twos have really rallied here. Tens have rallied too, but twos have rallied. So I think once you start to get cuts here and then growth and inflation starts to solidify, perhaps things go the other way where you get a bear steepening. So 10-year yields start to drift higher because the growth and inflation backdrop starts to
Keep
kind of
talking.
pick up a bit. Yeah. So I think that's one way that you could see this. Now, clearly, if I'm wrong, which look, we're all human, I could be wrong, and we're on the cusp of a hard landing here, then we'd probably get more. We could get more inversion as tens really rally to price in that harder landing. But I don't see that.
Because in your mind right now, the twos have overshot because if everyone's being pricing in way too many cuts, then this bull steepening that we've seen is going to pause.
Yeah.
And so in order for it to steepen any further, your case is that it have to be on the bear side of the tens.
Correct, yeah. Or it could flatten if like you start to get twos start to price out some of those
Yeah.
cuts. But I think the way so you'd have to think, well, why do twos price out the cuts? Well, twos would price out the cuts because growth and inflation is actually stronger and tens start to move up on the
Right.
back of that.
Right, right. All right. So listen, bud, let's talk about this yen carry trade because that was something for like a half a year. Everyone was boogeymanning this thing of like this is too crowded, and suddenly, wham! Just like that, it came to fruition. We had almost a 2,000 pip move in the US dollar yen on the downside. Obviously, volatility jolted through almost all global equity. Things got thinking, but like, how, first of all, how did it all play out in your mind? Tell us the story. And do you think it's over, or there are still risks associated with this trade?
Yeah. So last question first is I think that carry trade has completely unwound. If you look at net speculative positioning in the yen as a percentage of open interest across the contracts, you can see that we're basically I don't want to say max long yen, but we've gone from very short yen positioning to very long yen positioning. So I think that carry trade has unwound. I sent an email to some clients, which is three charts that really explained how this happened in my view. And really, what I think it was you were seeing basically like a correlation spasm in risk assets, right? So you had tech and semiconductors that were like leading the rally higher, but the equal weight S&P was really sagging. So there was this dispersion trade taking place, which
Mm,
was the topic of a lot of these podcasts. And so that was creating an opportunity for investors to kind of kept bet on tech continuing to outperform, but you could sell kind of like volatility against the market because that those tech names were going to drag the overall market higher. And for anyone with a charting platform here, if you actually look at the correlation between the S&P 500 and the equal weight S&P 500, that correlation actually went negative right
right.
before the vol spike. So that just speaks to that dispersion trade. And so yeah, you had a lot of short vol positioning in there, and then once you got a bit of a rotation to cyclical pockets of markets, and once you start to get a bit of it of maybe like bad news from some of the mega cap stock names, then all of a sudden that positioning unwound. And one of the best ways I think you could see this, if you were to look at the VIX, for example, the VIX hit 65, like a massive increase from the VIX for what was like a 4% drop in stocks,
Yeah.
right? So there wasn't really a big drop in stocks that corresponded to a massive uptick in the VIX because of the short covering that needed to take place because of the levered longs. And like an interesting juxtaposition or way to view this is during COVID, it took a sell-off of like 30%. Like the S&P 500 had to fall 30% to drive the VIX to 65. And here we got a 2% or a 4% decline and the VIX went to 65. So you can just see how levered those positions were. And that was kind of being backstopped or financed by the yen carry trade.
Yeah.
And so now I see positionings turned a lot more bullish on the yen. And then also what I've seen too is a lot of the variance control funds, so funds that are kind of benchmarked against VAR or value at risk. They have so they delevered coming out of that sell-off, and they've actually started to increase their long positioning as well. So to me, it looks like you don't really have those. You don't have those conditions in place for another redo of the yen carry unwind. Like there
Yeah.
might be something else that happens, but I don't.
You think the
It's
currency's overdone? Like, do you think that the US dollar has a reversion a little bit just from such an extraordinary move, or you think that the yen can continue to strengthen from here?
Uh, so as the Fed starts to cut rates this month and through November, I think you're going to see a little bit more dollar weakness here. It's priced in, but there's always these moves to come. Whereas in Japan, I think the markets just has been a little bit too I guess, dovish. And so,
Yeah.
in fact, like you're actually seeing there was a small chance of rate cuts as their next move. Now, you could argue maybe that was a bit of noise in the Japanese yield rates pricing, but inflation's running close to 2% there. Real wage growth is at 2%. That's what the BOJ said they'd want to see before they hiked anymore. So, like many other things in financial markets, nothing is clear cut one way or the other. But I do think there's some opportunity here for the yen to strengthen a little bit here as the Fed cuts start to come to fruition in the next couple of months.
There you go. Well, listen, Aidan, thank you so much for the update. But before I let you go, can you share with any of our listeners that are at the institutional level that want to follow your work where they can find you and follow your stuff?
Sure. So thanks for showing the cover page of the presentation deck here. You can email, myself or anyone on my team. Our emails are shown here. Mine is agarrib@pgmglobal.com. We service institutional investors. So if you are an institutional investor interested in global macro research, trade ideas, trade structuring, feel free to get in touch with me or any of my colleagues.
Aidan, thank you so much for coming on the show, bud. I look forward to having you back in the future.
Great. Thanks, Patrick. Take care.
No worries. Well, thank you for tuning into the Market Huddle Plus. We'll be back next week with another episode. Cheers, everyone.